Hi, I'm Andrew Meese, Chief Investment Officer for 6 Meridian. Thanks for joining us on another segment of Your Questions Answered. Today, we're going to talk about what's the story behind higher interest rates. If you recall in our last video, we looked at the decline in the stock market, so year to date, and when we decomposed that decline, it was clear that rising interest rates were a big driver of that decline. So today we're going to look at what's happened over the previous year that's caused rates to move so much higher. June of last year, June of 21, the 2-year Treasury was yielding 25 basis points, 0.25%. Today, the 2-year Treasury is yielding 3%. The reason that the 2-year is so important is because it incorporates investors' best guess of what the Federal Reserve is likely to do going forward. So when we look at over the last year, the primary driver of the increase in rates is changed expectations by investors for what the Fed is likely to do. So what's changed in the Fed's thinking? If we go back to the third quarter of last year, Jerome Powell, the chairman of the Fed, and most Fed governors, as well as a lot of leading economists, were talking about the inflation that the economy was experiencing as being transitory. And that simply means that the inflation we were experiencing was due to supply chain constraints, shipping issues, and other things going on in the economy that were a result of the COVID crisis. When we went into the fourth quarter, Jerome Powell was renominated for a second term as chairman of the Federal Reserve, and he started to talk about the entrenched nature of inflation and the strong economy, and the need for the Fed to probably tighten financial conditions starting in 22. So as a result, the 2-year Treasury started to trade higher. It ended the fourth quarter at roughly 1%. When we came into 2022, the expectation was the Fed would have modest hikes and they would gently reduce the size of their balance sheet. But then Russia invaded Ukraine in February, and that caused commodities to spike significantly. The market then interpreted this as being further reason for the Fed to become more restrictive and tighten financial conditions further. And at the end of the first quarter, the 2-year Treasury ended at a yield of 2.5%. The second quarter, which just ended, brought more information to observers with regards to the components of inflation, and most of that information led observers to believe that we had a more entrenched problem. The Fed was going to have to be more aggressive, and the Fed confirmed those beliefs from testimony that Jerome Powell gave to the Senate and the speeches that he gave regarding his intention to stamp out inflation, even if it caused a recession. We believe that the Fed is behind the curve, that the Fed probably was too late to tighten financial conditions, and that part of this could be due to the third quarter of last year and the fourth quarter of last year, when it was unclear if Jerome Powell was going to be renominated to head the Fed, and as a result, he was probably a little slow in starting the tightening process. Thanks for joining us today. If you have any questions, please reach out directly or contact your 6 Meridian advisor. Have a great day.